The stock market. You've always wanted to invest in the stock market, but the thing is, you just don't know how. Don't worry, we at Logical Minds have you covered. In this introductory series, we're going to break down investing to the most basic level, so that you can get started on investing in the market yourself. Who knows, you might become the next billionaire investor. To start off, there are 7 basic terms and ideas of investing that we're going to go over today, and they are stocks, market capitalization, shares, common stocks, ask, asset, and bid. Don't worry if you don't know these terms yet. We'll go over each and every one of them in detail. Let's start with stocks. So what is a stock? A stock represents ownership in a company. Companies divide their ownership stakes into shares, and the amount of shares you purchase indicates your level of ownership in the company. You've probably heard the term stock and share before, but are they really different? Although most people don't know this, stocks and shares are different, but their difference is so minute that they are often used interchangeably. You can think of the term stock as a pond. Stocks are a collection of shares from multiple companies. You can think of shares as the fish in the pond. They represent the ownership you have in each and every individual company that you have invested in. Shares of a company are usually bought in the hopes that the company will be successful and more people will want a stake. With the increased demand for a certain share, you can sell your own stake later at a higher price than what you had originally paid for. That is the ultimate goal of stock market investing. You want to buy shares of companies that you feel are undervalued and then sell those shares at a time when you feel a company's value has been reached or that it has become overvalued. To give a real-life example, let's say that I bought 100 shares of Tesla in 2015 when each individual share was worth around $240, and I decide to sell those shares today, which is July 10th, 2020. Today, each share of Tesla is worth $1,500. This is what I meant by buying shares of a company that you feel is undervalued and then selling those shares when you feel that the company has reached the proper share price. Now, when I initially bought 100 shares of Tesla, I paid about $24,000 for those 100 shares. However, when I sold those shares on July 10th of 2020 at $1,500 each, I got $150,000 back. To find out how much profit I earned, all I have to do is subtract the price of my shares when I bought them from the price of my shares when I sold them. In this case, that would be $150,000 minus $24,000, which comes out to $126,000. Man, I wish I had bought Tesla back then. The price of a share is always changing, but what does this changing price actually mean? The changing stock price affects a company's market capitalization. The market capitalization, or more commonly known as market cap, is the market value of a publicly traded company, and this can be found by multiplying the price of an individual share by the total number of shares that a company has outstanding. However, it is important to note that this formula will only work for publicly traded companies such as those that are listed on stock exchanges. To put into simple terms, you can think of the pond and fish example that we had earlier. If one share of a company represents one fish, then the market cap of a company is basically the population of an entire species of fish. All the same type of fish combined together from all over the world will equal the entire species of fish. Similarly, all the individual shares of a company from all over the world combined together to make the company's market cap. The stock market is like an auction place where you can auction the shares of different companies. In many auctions and in the stock market, each seller has an ask price. The ask price is a constraint that a share owner will place on a share. What this basically means is that the owner of the share will not accept a buy offer below a certain price point. We can understand this using our Tesla share example. I sold each share of Tesla at a price of $1,500, but that wasn't the only price that I could have accepted. If I had set my ask price to $1,400, then that means that I would be willing to sell my shares to a potential buyer for more than $1,400, but not less than $1,400. This brings us to our next term, which is bid. If I had set my ask price to $1,400, then how did I sell my shares for $1,500 each? This is because of bids. Because so many people were interested in buying shares of Tesla, I received multiple offers to buy the same shares. However, since each potential buyer wanted the shares for themselves, they offered more money per share. This would be an example of a bid. Now, once the buyer has placed a bid and the seller has accepted the bid, the ownership of the share is transferred over to the buyer. As a result, the buyer can now consider the newly bought shares as his or her asset. An asset is basically anything that has the potential to earn money for you or can be expected to gain value for you. Usually, assets are in the form of real estate, bonds, stocks, or other investments. In this case, they're stocks. However, before you place a bid on a stock, it is important to know what type of stock you're buying. Usually, when you engage in a transaction in the stock market, you're purchasing stocks known as common stocks. A common stock is, well, common. When people talk about stocks in general, they're most likely referring to this type. In fact, the majority of stock issued is in this form. Common stocks, particularly common shares, represent ownership in a company and a claim on a portion of profits. This claim is known as dividends and will vary per company. Investors of these stocks get one vote per share to elect the board members of the company issuing the stock, and these board members oversee the major decisions made by the management of the company. Over the long term, common stock has shown to yield higher returns than almost every other investment. This higher return comes at a cost, since common stocks entail the most risk. If a company goes bankrupt and liquidates, the common shareholders will not receive money until the creditors, bondholders, and preferred shareholders are paid first. Oh, that was a lot of information. But don't worry, we at Logical Minds are here to help you go from being a beginner in the stock market to someone who is actively investing in it. If you like the video, be sure to hit that like button and make sure to subscribe. Why? Because it's free, and who doesn't like free stuff?